Have you ever wondered why your planned production costs ended up different from the actual ones? One common reason is factory overhead costs (FOC), which are often hard to predict accurately. The difference between the actual and budgeted FOC is called FOC variance. What is FOC and full costing? First, you need to understand what FOC and full costing are. FOC, or factory overhead costs, includes all production costs other than direct materials and direct labor like electricity, factory rent, supervisor salaries, and machine depreciation. In cost accounting, we use the full costing method to calculate total production costs. Unlike variable costing, full costing includes both fixed and variable costs. That's why analyzing FOC is so important. It helps us see whether production is running efficiently or if there's waste that needs to be addressed. So, the difference in FOC happens because what's planned doesn't always match what actually happens on the ground. Maybe the cost of supporting materials goes up, work efficiency drops, or production capacity isn't met, like electricity prices rising or missing production targets. That's when FOC variance shows up. This variance is split into two: spending variance and idle capacity variance. Spending variance is the difference between actual overhead costs and the flexible budget based on actual capacity, while idle capacity variance is the difference between the flexible budget and the overhead costs charged to products. If the variance is favorable, meaning actual costs are lower than planned, it's called a favorable variance, showing the company saved money. But if actual costs are higher than expected, it's an unfavorable variance, which means there was waste or inefficiency in the product. Furthermore, the accounting treatment of FOC variances also depends on the cause. If the difference comes from the budget, the variance in FOC will be reallocated to the work-in-process inventory, finished product inventory, and cost of goods sold accounts. If the variance is favorable, the journal entry is. However, if the difference is unfavorable, then the journal entry is reversed. It is different if the variance is caused by differences in capacity. Then, the variance of FOC is treated directly in the income statement. If it is favorable, the journal entry is. If the FOC variance is favorable, it means the actual overhead cost is lower than the budgeted amount. This indicates a profit, which is recorded as additional income by debiting the FOC variance account and crediting the profit and loss account. The profit is then closed to retained earnings, increasing the company's equity. The journal is made if the FOC is unfavorable. If the FOC variance is unfavorable, the actual overhead cost exceeds the budgeted amount. This causes a reduction in profit, recorded by debiting the profit and loss account and crediting the FOC variance account. The loss is then closed to retained earnings, reducing the company's equity. Example 1. Case. In 19/1, PT ABC recorded actual machine hours of 75,000. The standard FOC rate is 140 Indonesian rupiah per machine hour. Actual factory overhead costs were. Step 1. Record actual FOC. Cash consists of electricity costs, employee benefits costs, and repairs and maintenance costs. Step 2. Calculating applied FOC. First, we calculate the applied FOC based on the actual machine hours used. In this case, the total machine hours are 75,000 hours, and the FOC rate is 140 Indonesian rupiah per hour. So, the applied FOC is 75,000 multiplied by 140 Indonesian rupiah, which equals 10,500,000 Indonesian rupiah. Step 3. Calculating FOC variance. Next, we compare the actual FOC with the applied FOC. The actual FOC incurred is 10,700,000 Indonesian rupiah, while applied FOC is 10,500,000 Indonesian rupiah. The difference is 200,000 Indonesian rupiah. Since the actual cost is higher than the applied, this results in an unfavorable variance. Step 4. Journal entries for FOC adjustment. We then record the FOC adjustment. First, we record the applied FOC to match it with the actual FOC incurred. Then, we record the 200,000 Indonesian rupiah variance, which reflects the underapplied overhead. Step 5. Variance analysis. This variance should be analyzed further. If it's due to higher spending such as increased electricity rates or unexpected costs, it's called a spending variance and is allocated to work in process inventory, finished goods inventory, and cost of goods sold. But if it's caused by unused capacity or idle time, it's known as idle capacity variance and is charged directly to the income statement. Example 2. Let's look at another example. A company uses the full costing method to calculate the cost of the products it makes. In one period, they used 60,000 machine hours. The standard overhead rate is 120 Indonesian rupiah per hour, and the actual overhead cost they spent was 7,400,000 Indonesian rupiah. Step 1. Calculating applied FOC. The applied FOC is calculated by multiplying the actual machine hours by the standard rate. So, 60,000 hours times 120 Indonesian rupiah results in an applied FOC of 7,200,000 Indonesian rupiah. Step 2. Calculating FOC variance. The FOC variance is found by subtracting the applied FOC from the actual FOC. That is, 7,400,000 Indonesian rupiah minus 7,200,000 Indonesian rupiah equals 200,000 Indonesian rupiah. Since the actual cost is higher than the applied amount, this variance is classified as unfavorable. Step 3. Journal entries for FOC adjustment. At this stage, we record the applied FOC to align it with the actual overhead costs incurred. This ensures the accounting records reflect the amount of overhead that was charged to production during the period. Step 4. Recording FOC variance. Next, the unfavorable variance of 200,000 Indonesian rupiah is recorded to reflect the excess overhead cost. This entry helps highlight that the company spent more than expected on its overhead, possibly due to inefficient machine usage, higher utility rates, or unexpected operational costs. After understanding FOC and full costing, we can conclude that FOC variance is the difference between applied and actual overhead. These differences arise due to price changes, efficiency issues, or production volume variations. This analysis goes beyond numbers. It helps management control costs and boost operational efficiency. Understanding and analyzing overhead variance is not just about accounting entries, it's a key part of real-world cost control. Accurate calculations and proper journal entries help businesses assess production strategy and efficiency. We hope the explanations and examples provided a clearer, more practical understanding of how FOC variances are calculated, analyzed, and applied in decision-making. Thanks for watching until the end. Hopefully this knowledge helps you in the future.